Welcome back to Investing Talk Podcast.
Today we're looking at Palantir.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave in the comments below.
So let's get into the analysis.
Yeah, let's do it.
What we've been seeing recently suggests Palantir is really in what you'd call a structural acceleration phase.
Right. They're moving beyond that old label of just being a government contractor.
Exactly. They're shifting, and I mean fast, to become a central player in enterprise artificial intelligence.
And that shift is it's generating explosive results, especially on the top line.
It really is.
In the last quarter, total revenue hit, where was it, $1.18 billion?
That's right, a 63% jump year over year.
But the real story, like you said, isn't just the overall number, it's where that growth is actually coming from.
That's the critical pivot point, the domestic commercial demand.
I mean, that's the number that jumps off the page.
Absolutely. The U.S. commercial revenue growth, it accelerated significantly. We saw it rise 121% year over year.
121%.
Yeah, to about $397 million. And this is driven almost entirely by the adoption of their AI platform.
AIP.
Right, AIP. It's automating these incredibly complex tasks for clients across, well, all sorts of industries.
And while that's all happening, the government side isn't exactly slowing down, is it?
Not at all. U.S. government revenue growth has hit 50% plus year over year for 2 straight quarters.
Which is a big step up from where it was trending before.
A very sharp step up. And this momentum, you can see it right in their deal flow, the total contract value, or TCV.
The future revenue pipeline, essentially.
Exactly. It reached $2.76 billion. That's 151% growth year over year.
Wow. And that includes a lot of big deals, right? Not just small pilots.
That's a great point. It included over 200 contracts, each worth more than $1 million. So yeah, these are major commitments.
Okay, so beyond that top-line growth, the operational leverage here is, well, it's very impressive.
It's more than impressive. It's almost unheard of at this scale. They hit an adjusted operating margin of 51% in Q3.
51%. So if you take that margin and the 63% growth, that puts their Rule of 40 score at what?
A stellar 114%?
114. Just for context, anything over 60 is usually considered exceptional for a software company.
It really is. It's why some analysts are even saying they're moving toward a Rule of 80 plus profile. It just shows how profitable each new customer is.
And all of this hypergrowth doesn't seem to be hurting their balance sheet.
Not in the slightest. Unlike a lot of high-growth tech stocks, they have a very strong balance sheet. They're operating with a net cash position.
Meaning more cash on hand than total debt.
Materially more. And all that free cash flow they're generating, it's being pumped right back into the business.
Into R&D and scaling up sales for AIP.
Exactly. They're not focused on dividends or buybacks right now. It's all about capturing the market.
Let's talk about their competitive advantage, their moat, because that's what justifies the long-term thesis.
It is, and it's multi-layered. You have their core platforms, Gotham and Foundry, and now AIP, which sort of sits on top of everything.
So how does that create a durable advantage against, say, the big cloud providers or other AI startups?
It comes down to integration and incredibly high switching costs.
Right.
Think about it this way. Once Palantir is embedded in a company's critical workflows, whether that's defense logistics or optimizing a factory floor, it becomes the central nervous system.
It's not just a tool you can unplug.
Exactly. Ripping it out would mean rebuilding core operational systems from scratch. The cost and the risk are just immense. That's a real durable advantage.
So how is the market taking all this? Investor sentiment seems broadly bullish.
It is. The stock doubled in 2025. It was up somewhere between 140 and 160%.
And that's being seen as a secular trend, not a short-term pop.
I think so. The recent pullbacks are being seen more as healthy profit-taking. You're even seeing analysts call these dips buy-on-weakness opportunities.
And Wall Street is backing that up. We saw Truist, for example, initiate with a buy rating.
Yeah, and a pretty aggressive price target of $223. They called it a best-in-class asset in the Gen AI space.
And the highest target on the street is even higher. Right?
Yeah, I believe it's $255.
Okay, but now we have to talk about the elephant in the room.
The valuation.
The valuation.
Yeah.
The stock trades at let's just say, a substantial premium.
That's putting it mildly. The PS multiple is around 100x. Forward-adjusted PE is upwards of 226x.
Those are eye-watering numbers. It means the market is pricing in just absolute perfection for years to come.
It is, and that's the risk. If revenue growth decelerates even a little bit after 2026, or if there's a broader rotation out of software.
That premium is vulnerable.
It's very vulnerable, and we know there's some whale activity, some big players betting against the stock for exactly that reason.
So how does that get mitigated? How does the company grow into that valuation?
Well, the bullish counterpoint is that the fundamentals are just compounding so incredibly fast.
So the growth rate itself is the mitigation strategy.
In a way, yes. Analysts are forecasting revenue CCAR in the mid-40s and GAAP EPS CAGR around 84% through 2027.
So if they hit those numbers,
If they hit those numbers, they effectively solve their own valuation problem over time. They grow into the premium.
so looking ahead, what are the near-term catalysts we should be watching?
The big one is the Q4 2025 earnings release. That's expected in early to late February.
What are we looking for there?
Two things, really. First, can they beat their revenue guidance, which is already high, around $1.33 billion? And second, and this is crucial, do they raise their guidance for the full year 2026?
A guidance raise would signal that this acceleration is continuing,
Exactly. That would be a huge catalyst. And then you have the macro tailwinds.
like the defense budget and the overall AI spending cycle.
Right. Both of those are massive tailwinds that aren't going away. Palantir is sitting right in the sweet spot for secure production-grade AI.
So to sum it all up, it really seems like Palantir is successfully making that transition from a niche government vendor
To a foundational AI infrastructure asset for both the public and private sectors.
And the question for investors really is whether its accelerating commercial growth and these robust margins can sustain that premium valuation.
Can they sustain it long enough for the compound returns to really materialize? That's the key.
A great way to keep track of that story is by staying subscribed to the Investing Talk podcast. We'll continue to track the earnings and contract announcements as they hit.
Make sure you subscribe for our next analysis.